Hi, everybody. This is Gary Dean with Sentiment Timing. This is our free Sentiment Timing video report for Tuesday, November 3rd, 2015. Sorry I didn't get one out last week. Had a few things going on, and honestly, the market's been kind of boring. But honestly, this is this is the time that you really want to be paying attention. Usually, when the markets just go in one direction, especially up, everybody becomes very complacent, and that's usually the time you want to get a little bit nervous. So let's get started. The sentiment timing, we believe that human beings in the markets are irrational. There's always going to be an irrational element at work, and that is what creates market opportunities. Now, we identify these irrational elements through Woody Dorsey's proprietary database, sentiment database, as well as his technical timing indicators, which let us know, when to expect some type of turn. So what we do is we combine them all into a matrix, and what it is we use the time aspect. So the technical timing is what gives us the heads up as to when to expect a turn. Sentiment gives us an idea of how traders are feeling. So is it supporting the expected turn? And then we used our regular technical analysis to determine where, and is there price divergences and stuff like that. Now, are the timing indicators going to be right all the time? No. There's nothing that's out there that's going to be right. Woody's, obviously, his technical timing indicators are better than just about anybody out there, because it's above 85%, and these are terms that come very close to the exact days that that he's anticipating some type of turn. And the thing is, it's not even a matter of getting it exactly on the date. It's knowing whether you should be comfortable with the rally, whether you should be looking to buy a dip, or you should just kind of have an open mind and understand that things are unclear. And that's kind of where we are right now. And the reason, one of the things that we do, the investor sentiment data, it's pulled. It has 100 different listing posts, and what it does, it comprises of thousands of sentiment sources. So that's how that's how Woody gets the sentiment data. All these things get filtered through into a database, and this is what we are showing, and this is why there's times when things get a little skewed, and we've seen it before, and it usually happens after a big plunge. And we've seen high sentiment readings, but that doesn't mean it's a you have to take a short position. What it means is you want to be a little bit careful, because everybody is on the side of assuming that the markets are going to go up. So that is when you want to get a little bit nervous. It's when you want to be looking to buy is when you get these 1% when nobody is bullish. So it's a technical indicator that doesn't it's not based off of price. It's based off of human emotions. And again, they're not exact buy here or sell there, but they're going to give you an idea what you should be doing. Now, I'm showing you this for the reason this is our live, this is what we just put out today. And it's important because right now there's not many people that are expecting any kind of pullback. They're, calling it the Santa rally right now, and we're heading up to 2150, 2200. And when we were down here, these same people were calling for 1750 or the start of a new bear market. So they're basically just jumping on the trend. And that's what I mentioned in the beginning is when you want to get nervous is when nobody is nervous. And that's, it's one of the things that it's a very important aspect, because the markets aren't letting you out in or out of this market. They're moving at lightning speed. So sentiment timing, we use proprietary sentiment and timing tools to diagnose market conditions. Our regular technical analysis can then isolate specific trade setups. And if you're in the market, you really should know by now that the time to buy is when everyone is nervous, and the time to be nervous is when everybody is complacent. And I'm saying that because everybody is complacent right now, and we know they're complacent from this. I'll show you the first chart. This is the VIX. this is when everybody was complacent before. This was going through basically all of 2015 in the beginning. And everybody was looking for 2150, 2200. There was no pullbacks. And then we saw the VIX shoot up. Right now, I can base it off of just our, from subscribers. When the VIX falls, so does our subscriber base. Once we get this kind of, bump in it, we get 200-300 people that sign up for it, and they want to know what's going on. But obviously, it's too late for things because we get these moves that are moving 100, 200 points in a matter of weeks. So here's the S&P. We have bearish divergences. This is a resistance zone. Now remember, this is when everybody was complacent. Everybody was looking for 2100, and they took that fantasy that time out of the equation, and this is when everybody got bearish. So we're back up here again. We have bearish divergences. We're very overbought. But until price breaks, even though we have very high sentiment readings and everything is everybody's looking up, we still need some kind of price break, and we have not seen that yet. But the problem with it is that, when it gets extended like this, we run right into resistance. There's been no breaks, and the real support is sitting all the way down at this 2020. These, 2-day support levels really aren't anything. But really what the bears would need to do to get momentum going is getting it through this, through the 2060 down to the 2020 area, and then that's when you can almost expect that we would get a quick move down to the 1990 area. So on the 60-minute chart, again, we have the bearish divergences very overextended right now, and we have this bearish wedge. So it's just a situation right now that I wouldn't be buying into this 2150, 2200. It may get there, but when you have sentiment at levels that they are, and you have this bearish rising wedge with bearish divergences, typically this would be calling for a move to come down to the 1993, and nobody is even anticipating anything like that. So, is it going to get there? I don't know, but the thing is that you can take it an early stay on it and say, okay, if the bulls lose this 2106 level, which is not that far above, then the next move is coming down to this 2092, and if they lose that, then we're going to see that quick drop down to the 2078 level, and this is where what the bulls have to defend. If they lose that, then we are going to get a retracement down to this 1993, say the 2022 down to the 1993. But again, you need price to break, and this is the pattern is not something you really want to be getting all that bullish on. Even if it does drift higher, you have everybody that's on the same page that you are and expecting it higher, and the patterns is pretty dangerous. And like I said, they don't. This isn't a market that lets you think about things. It just completely drops or it completely goes up. So, like I said, you wanna you want to be nervous when nobody is nervous, and you want to be buying when everybody is nervous. And, that's what Woody's been doing for 40 years. So with that, until next week, have a great week trading, and good luck.